harder than it really is. Okay, because I think the way they write the equations, it seems a little bit harder than it really is. So let me just kind of explain to you where we are. So if we're thinking about the balance sheet, and we're thinking about the fact that a company is going to look at their assets differently than you do, because when they bring on the fixed assets, what they're doing is they're bringing those fixed assets on their balance sheet to generate future cash flows. So they're going to buy a piece of machinery, a piece of equipment, they're going to build a building, buy a truck, whatever, in order to generate sales. And so we're going to take Chapter 11 and use the concept of Chapter 11 for Chapter 13, because Chapter 13 is where we're going to evaluate the fixed assets. But before we get there, what's happening is we have to figure out how a company is going to evaluate those assets with regards to what they need to earn in order to make those assets bring a return to the company. So on the balance sheet, what we see on the right-hand side is we see accounts payable, we see accruals, we see, I'm going to call it long-term debt, and as you know, some of it will be in the short-term arena where you put the current maturities that are going to be due within 1 year within your current liabilities, but basically classifying all of that then as interest-bearing debt. So IBD, I write that as interest-bearing debt. And then remembering the way the balance sheet looks to our author, the right-hand side is made up of debt and equity. So you just break it down. All liabilities are going to be considered debt when we first got started with this author. And then after that, you've got your equity section. And we're going to basically focus on common equity. I'm not going to put any preferred shareholders in this, so that's another part of the equation that's going to go away for us. So again, our focus is going to be on the right-hand side of the balance sheet, because what we're trying to do is we're trying to determine how a company is going to know how much these fixed assets need to earn, looking at then getting their debt holders and their equity holders paid back. Because remember we talked about how risk is the probability of an unfavorable outcome. So a company could have positive cash flows, they could have net income, but that might not be a favorable outcome to them, because if they're not getting their debt holders and their equity holders paid back for what they need for the risk that they're taking investing in the company, they're not going to be in business very long. Because at a minimum, they need to get their debt and equity holders paid back. That's the very minimum that a company needs to do. So we call this concept then that we're going to be dealing with today, we call it the concept of weighted average cost of capital. Weighted average cost of capital. So again, we've talked about how capital can be a confusing word in the world of finance. Capital meaning, to us in this chapter, capital meaning how we have financed our company. Have we gone out and got debt? Have we gone out and got equity? How did we finance our company? So what I'm going to do then is kind of rearrange what they're doing just to give you guys a different look at the equation. Let me see where the equation is even. I thought I had it marked, sorry. Oh, there it is. It's right in front of me. It's on page 374. It just looks weird. Okay, so when he's writing that equation on page 374, like I said, he's making it look harder than it really is. So I would like to rewrite it so that you guys can see it, and I'll keep in his order, but most authors don't start with equity. Most authors start with debt. So on some of the review stuff, you might see that. But let's call it WS, so weight of equity. And then I'm going to call it I sub S, so that's going to be cost of equity. And I'm putting the S there on purpose, and I'm going to tell you why here in a minute, but let's just go with the equation. So W sub S, weight of equity, times I sub S, cost of equity, plus then your weight of debt times cost of debt times 1 minus the tax rate. And that's basically what the author's doing. I'm just hopefully making it a little bit more user-friendly and with words and less. So there's two weighted average cost of capital. So the first one I'm going to have like the weighted average cost of capital sub S. So that's going to be using the I sub S, and like I said, I'm going to explain that here in a minute. The other one is going to be using a sub E for your equity. And like I said, I'm going to explain all this, but if you guys will just get it in your notes, it'll all start to make sense. I would just like to get it set up. Because that's basically a roadmap of where we're going. So the second equation then, I have weighted average cost of capital, and I put a little sub E there, because what I'm doing is I'm saying weight of equity with a sub E, cost of equity with a sub E instead of a sub S, that's the difference. Plus then your weight of debt, your cost of debt, and 1 minus the tax rate. So let me just make up some numbers and let's do a little example up here together. Let's pretend like you had accounts payable and accrual of $10. You had interest-bearing debt of $40 and equity of $60. So you had $110 on the right-hand side of your balance sheet. That would mean that you would have $110 on the left-hand side of the balance sheet because assets equal liabilities plus equity. So there's two ways to approach weighted average cost of capital. The one that we're going to use in class for the demonstration, and then I'll talk about the market-based one because there's some homework on that. But the one that we're going to use in class, and the one that you guys use a lot in Finance 440, is you just use the balance sheet, and then you start moving from there. Because you're saying, okay, the company, this is how they have financed their company, looking at their debt and equity. The other way is we'll look at it market, but let's just look at it, like I said, for right now, based on their books. And we know the problem with the book value is more with the equity section because we talk about how equity section isn't always necessarily market value because of things that are going on in the balance sheet and how we use the matching principle of accounting. So again, we're just going to talk about the book just so that we can at least get started somewhere. Weighted average cost of capital with the little sub S. So looking at our example here, let's pretend like we wanted to calculate a weighted average cost of capital for this company. So weighted average cost of capital with the sub S. Let's talk about the weights first. What's happening with weighted average cost of capital is we want to ignore accounts payable and accruals. We only want to focus on the interest-bearing debt. When you get into Finance 440, you'll start to understand the cost of accounts payable, like whether you want to pay it off at the discount or not. But for this class, we're going to assume that accounts payable and accruals have no cost to us because we want to start somewhere. So what we're saying then is when we're looking at weighted average cost of capital, what we're going to be considering is the $40 of interest-bearing debt and the $60 of the common equity. And that's total equity then. Everything that's in the equity section makes up that $60. So we want to look at everything that's in the equity section because whether an investor puts money into the company out of their pocket or whether they leave earnings in the company, don't take out a dividend, don't take out a distribution, however you want to look at it, they want a return on whatever they have in that company. So that's why you take the total common stockholder equity. when we're looking at weighted average cost of capital. So, and this is what the author is basically doing. So, when we want the weight of the equity and the weight of the debt, what we're basically going to do is we're going to say, okay, how many dollars do we have in equity? We have $60 in equity. And then how many dollars do we have in interest-bearing debt plus equity? So that's how we're going to come up with the denominator then. So for our weight of equity, WS, the numerator is going to be $60, the denominator is going to be $100. Then for our weight of debt, we've got $40 in interest-bearing debt. Then once again, we've got $100 in interest-bearing debt plus equity. So the numerator for the weight of debt is going to be $40. The denominator is going to be $100. So for my weights, what I'm coming up with is I'm saying, okay, 60% is of my company then is formed with the equity, and then the 40% is interest-bearing debt. And I purposely write those in a decimal format because then later on, when I'm double checking my work, I can make sure that that equals 100% or a 1. Your weight of equity plus your weight of debt has to equal 1 or 100%. So if you accidentally include accounts payable and accruals, then that will mess things up because interest-bearing debt and equity is your denominator, the $100. So we don't care about the 110. We don't care about total assets. All we care about is interest-bearing debt and equity. Any questions on how I came up with the weights? I sub S, you have two equations for calculating the rate of return for equity. We learned the first one based on dividend yield and capital gain. So D sub 1 divided by P sub 0 plus G. Then we learned the risk-free rate of return plus beta times the return on the market minus risk-free. So our SML equation. And this other one, we call that the discounted cash flow approach. The first one that you learned based on the dividends and the capital gain or the growth, that's called the discounted cash flow approach. So for this example, let's go ahead and use the discounted cash flow approach because then I can expand on that when we get to the next weighted average cost of capital equation. So again, I'm just going to make up numbers. Let's pretend like a company is forecasting that they're going to pay $1 dividend for the next dividend. Let's pretend like the stock is selling for $10 a share. And let's pretend like they have 5% growth. So using the discounted cash flow approach, I'm saying then that this would be 10% plus 5% or 15% for the cost of capital. Is everybody with me on what's going on? I'm just making up numbers. So in my weighted average cost of capital equation then, what I would do is I would say, okay, 15% is my I sub S, my cost of capital. Now what's going to happen is the math, the algebra, once again is going to support what's going on because it's going to be that we want the weighted average of the cost of capital and the cost of debt. So So the cost of debt is going to be determined, if you think about it, when we talk about bonds, if they had bonds outstanding, we wouldn't look at the coupon rate of that bond because that's something that historically they figured out, and maybe that's not really reflecting what's going on in the market right now. So what might be more prevalent then to use would be the yield to maturity if they had bonds outstanding, because that would be their next dollar cost of debt. So remember, here's the goal. We're going to use the weighted average cost of capital equation to evaluate buying fixed assets in Chapter 13. So what we're really talking about is the next dollar cost of debt to the company. So what's happening is that if you have debt already and you go out to get another loan, chances are, as you get more and more loans, your interest rates are going to go up. So one of the problems with doing this calculation is that we can't just look at the financial statements and go to the footnotes of the financial statement and see what interest rates they're paying, because what we need to do is find a way to project out then what their next dollar cost of debt would be. So that's why if they have bonds outstanding, yield to maturity would be a good way to look at it. If you're running a company, you're going to know this more than if you're an outsider looking in. If you're an outsider looking in, you might just have to get some kind of a feel for what's in their footnotes, or like I said, use yield to maturity. I'm just going to make something up. Let's pretend like their yield to maturity is currently, I don't know, let's say 10%, just to keep it easy to deal with. Let's say their yield to maturity is 10%. So you did the calculations using the bond information, which is one of the things the author will make you do. Go back and revisit bonds so that you can calculate a yield to maturity. And then our focus then is taking that times 1 minus the tax rate. Why is it times 1 minus the tax rate? Well, if you think about it, on the income statement, what happens is you have earnings before interest and tax. You subtract interest to get earnings before tax. Then you pay tax to get down to net income. So what's happening is, by having that interest expense, pay interest-bearing debt, you're going to pay interest expense. By having interest expense, it's going to save you tax. So let's pretend like they're in, I'll just make it up, a 30% tax bracket. So then what you're saying is if they pay $1 in interest, that's going to save them 30 cents. So instead of having that interest cost them a whole dollar, it saved them 30 cents in tax, so the way they look at it is that interest really only cost them 70 cents. Does that make sense? Since I had that extra expense, I got to pay less in taxes, so that's why I'm taking the cost of my debt times 1 minus my tax rate. But if you think about it, what happens then is dividends and or then capital gains occur after net income. So once again, our equation and the algebra support what's going on, because when I'm looking at the cost of my equity holders don't save me tax. It's my debt holders that save me tax. So calculating through the equation, 15 times 0.6, so that would be 9% plus 10 times 40% times 70%, 2.8. So the weighted average cost of capital with the sub S for this company then is going to be the 11.8%. Does it make sense so far? Does the algebra, does the calculation, do the variables make sense so far? Let's kind of focus on that. Does that part make sense with what's going on? So then the concept is questions or comments on that? The most common mistakes that students make, okay, is they forget that tax only impacts debt, and then they start making decimal errors. If you look, I purposely put my weights in a decimal format, and I purposely put the cost of equity and the cost of debt in the whole number percentage, because at the end, what I need is, I need my answer to be in the whole number percentage. So since I know that's my goal, I don't want to make decimal errors along the way, so I just kind of make sure that I keep to that format. Everybody good so far? So weighted average cost of capital, when I use the little sub s, what I'm saying then is I'm using the shareholders that I have right now. So if there's a comment that says, what would be your weighted average cost of capital, and a lot of times they'll call it with retained earnings. And what they're saying with that kind of verbiage is, if they say weighted average cost of capital with retained earnings, they're saying with your current shareholders. So the other way to look at it then is weighted average cost of capital with the little sub e, and so that's if you have external equity. So here's the concept. If you're looking at buying assets for your company, you'll be in one of two states. Either you'll be where you can buy the assets with the cash flow that you have now, or you might have to go out and sell additional stock. So in Finance 340, we're keeping it that if you had to go out and get additional funds, you would keep the 40-60 split. In Finance 440, you're going to take it differently, and you'll say, okay, but what happens if I don't want to go sell stock and I just want more debt, or things like that. But here's one of the keys. One of the keys to this concept is you're not specifically identifying which assets are causing the debt, or which assets are being purchased with debt and which assets are being purchased with equity cash flows. When you look at assets, you don't care how you're bringing them on. You just know you have to use cash. So if I had to go out and I had to buy this podium, this chair, and this desk, I wouldn't specifically identify that maybe I got a loan from the bank and used this podium as collateral. Okay? Well, if that was like 10%, I wouldn't look at this podium and say, okay, it has to cover the 10% that it's costing me. No, I would have to say this podium has to cover this 11.8%. Same way with this chair. If I could buy this stool here with my current shareholders, I wouldn't say, okay, my current shareholders are really the ones buying this, so that's 15%. No, I'm not specifically identifying where that cash flow came from, so I'm just saying 11.8% for this. But what happens now if I have to move out and go get external equity? So what that's going to look like, that's where I come in and I have an I sub E instead of an I sub S. So I'm going to use the discounted cash flow approach for calculating then my I sub E, which is external equity holders, versus I sub S, which was my retained earnings or my current shareholders. So let's go back and think a little bit about our stocks. When we were talking about shareholders and what they would expect to get if they purchase stock, we developed a piece of zero, price zero, based on dividend 1 and growth. We never stipulated who they were buying the stock from, did we? We never said, okay, let's calculate a price if they're buying the stock from one of you who is already a shareholder. Or let's calculate the price if they're buying the stock from the company itself. we never stipulated who they were buying the stock from, because what we said was a shareholder is gonna be willing to pay a certain price, or the value they're willing to pay is based on the future cash flows, okay, so D sub 1, and the growth that they would get when they are participating in that stock. So what's gonna happen then is, when we look at the cost of external equity, this is from the company's standpoint only. A shareholder would never think of I sub E. Company standpoint only. So we know that if the company sells additional stock, they still have to come up with D sub 1 for all of those common shareholders. They can't say, well, you just bought your shares 6 months ago, so you don't get D sub 1. That's not what happens. When they pay that dividend 1, they have to pay it to all of their shareholders, no matter how new they are. So D sub 1 remains. The growth is going to remain, because like we said, the shareholders are participating in the growth. And we said that the P sub 0 is going to be the same, because we're not going to stipulate a price based on buying from the company versus buying from another person. So what's going to change is what we call float cost. And there's several different ways that the float cost is going to be written. So I'm going to put a couple of different equations up here. If float costs are just written in a dollar amount, that's pretty easy, because it's P sub 0 as a dollar amount minus your float cost as a dollar amount. The way the author writes it, if your float costs are written as a percentage, they say it's P sub 0, the dollar amount, minus your P sub 0, the dollar amount, times your float cost, a percentage. The way my brain works, because I'm so used to 1 minus the tax rate when I do a lot of stuff in evaluations, another way to write that would be P, the dollar amount, P sub 0, the dollar amount, times 1 minus the float cost, the percentage. So that would be the three ways that you can look at it. So the easiest one is on the top, P sub 0 minus the float dollar amount, where you've got dollar amounts for both. The author's version, if it's a percentage, your denominator is P sub 0, the dollar amount, minus P sub 0, the dollar amount, times the float cost, and I'll do different versions for you. And then the Peggy Ward version, where your denominator is P, your dollar amount, times 1 minus your float cost. I don't know, that's just how I see it. That's the easiest for me. I'm going to scoot this over so I have some room. So weighted average cost of capital, if I have external equity. Okay, let's do the discounted cash flow with a dollar amount. Okay, so my original example was I had $1 for my expected dividend. I had 5% for my growth. And then I was saying that the price was going to be $10. I'm just making up float cost. So let's pretend like I say float cost is $2. So $1 divided by $8, 0.1250 plus 0.05. So now, oops, that's a percentage. Why did I put a dollar there? Don't do that, don't do that. My weighted average cost of capital would need to use the cost of the external equity, the 17.5%. If that would have been stated as 20%, because that's basically what that is, here's how your equation would look. It would have been $1 for your numerator, 5% for your growth. Then if you did the author's version, it would have been $10 minus $10 times 20%. Still gets you to the $8 for your denominator. Then if you wanted to do the way I do it, $1 for your numerator, and then your price, your $10 times 1 minus your float cost of 20. So it still gets you to your $8 for your denominator. So no matter how you do the calculation, whether you're given percent or dollar, you end up with 17.5% being your cost of equity. Any questions on how to calculate that external equity cost? After you get the external equity cost, you're ready to plug that into your weighted average cost of capital equation. So once again, it's weight of equity with an E this time times cost of equity, weight of debt, cost of debt, 1 minus the tax rate. So like I said, for Finance 340, we keep it really simple. We just say that this is going to be the company's optimal capital structure, and you guys will understand what that means. In other words, this is where they want to be. They want to be at 60% debt, and 40% debt and 60% equity. Like I said, this author does these backwards. Most people put debt first. Then what we're saying is now we're going to look at what it's like if we have to go out and sell stock or have external equity. So I'm going to use the 17.5% for my cost of equity. But since we're using the concept that the 10%, that cost of debt is our next dollar cost of debt, I'm going to leave that the same, and I'm going to leave my tax rate the same. So the only difference between the two weighted average cost of capital is, do I have my current shareholders, am I using retained earnings, or do I have to go out and sell additional equity? So I use my ISA B. So if I had to go out and get additional equity, that's 10.5% plus my 2.8%. So now it's going to be 13.3%. Any questions on how to do the calculation of that weighted average cost of capital with your external equity? So here's the concept. If I'm not having to sell any stock at all, and I wanted to buy these 3 items, all 3 of them would have to cover 11.8%. If I had to even sell 1 share of common stock to buy all 3 of these assets, remember, I'm not going to specifically identify which ones were bought with debt, which ones were bought with current shareholders and external shareholders. So then, if I want to buy these 3 assets, all 3 of them have to cover the 13.3%. Okay? A couple of rules. I sub S and I sub B are never in the same equation. That's like one of the #1 mistakes on the exam. People try to put I sub S and I sub B in the same weighted average cost of capital. The concept is, I'm either using my current shareholders only, or I'm selling at least 1 share of common stock, which moves me to this other equation. it'll just be interest-bearing debt and common equity. So don't let it confuse you too much. The other concept then that you need to kind of understand from a company's point of view is, and they start talking about this on page 383, where they start talking about what it would be like then if you have a company that has a lot of different divisions. So let's pretend like we have this company, and let's just go with the 11.8% weighted average cost of capital that we came up with in class today. So let's pretend like this is your company, and they have a weighted average cost of capital for the overall company of 11.8%. Well, what happens is in companies, especially large companies, Fortune 500 companies, what'll happen is they participate in a lot of divisions. They participate in a lot of different industries, I guess is the best way to say that. Like one of the companies I was with, we had an automotive division, we had a sign division, we had an office product division. Okay, all of those industries are completely different. And they're gonna act and react to the economy completely different. So in my example here, let's pretend like we have a division that's high risk. Let's pretend like we have a division that's average risk, and we have a division that's low risk, compared to the company as a whole. So here's what happens. This is more of a practice thing. Because the way the author presents it, and you can do this at the division level. At the division level, you can go and you can look at what kind of a beta you have for each of those divisions, and you could use this type of an equation, your SML equation, to try to go figure out the cost of equity then for that division. But here's what really happens in practice. If you buy into a company, you're buying the whole company. You can't just say, I like this company, but I only like this division that they participate in, I don't like the other three. You're buying the company, you're buying the stock, you're giving them a loan by buying a bond, so you are participating in the company as a whole. So usually what a company does is they start looking at just having some risk adjustments. So they do look at what industry their different divisions are in. They do try to get a feel for how risky it is, what the beta is compared to the market as a whole. But usually what they'll do is they'll say, okay, what's my company-wide weighted average cost of capital? And then they'll start adjusting it for the risk that's in each of their divisions. So if it's an average risk division, so it's the same risk as your company as a whole, it would carry the same then hurdle rate for evaluating assets as the company as a whole. So as that division is trying to buy fixed assets, and they're trying to evaluate which ones they should participate in or not, the I that they would put in their calculator, okay, when you're calculating your cash flows, your net present value, would be the 11.8. And then they would figure out, let's just make up something. Let's pretend like the company determined that the high-risk division needed 2% more return than the average risk. So then when that division is putting in their cash flows and evaluating them, they would have to cover 13.8%. Because the more risk that that division is taking means that they have to come up with more return in order to pay back the shareholders, the debt holders for that additional risk. The flip side then would be if you have a low risk division, and these wouldn't have to be the same numbers, I'm putting -2. Maybe this is actually -3 or -1. It doesn't have to be a mirror image. But what we were saying then is they would come up with some kind of an adjustment. Let's pretend like it was -2%, because if you're taking less risk, you don't deserve the whole 11.8% reward. So you would want 9.8 to be the hurdle rate, or the amount, the IY, that you would put in a calculator when evaluating the assets. And that's going to make a lot more sense in Chapter 13. When we start evaluating assets, it's going to make sense where this is sitting. Then, when the author talked about projects and talked about project betas, academically, they almost make it seem like every time a company decides to buy a podium, build a building, whatever, they go and look at the project and determine a beta. Let me tell you, for some companies, it's hard enough to come up with a company beta, or maybe a division beta, let alone a project project-specific beta. So what they do then within a company is they'll say, okay, within each division we'll have high, average, and low risk projects. Because just because that I'm sitting in the low risk division doesn't mean that everything that they do is going to be low risk. Some of their projects will be riskier than others. So once again, they'll come up with, and I'm just going to make it be, kind of mirror image. They'll come up with some kind of a factor. So if you're in the high risk division and it's an average risk project for that division, the I in the calculator would be 13.8%. If it's high, I'm just going to add 1. Maybe they add a percentage. If it's low, they would subtract some, and I'm just saying pretend like they subtract a percentage. So if I'm in the high risk division of this company, I'm using 14.8 to 12.8 to calculate the rate of return that those projects need. Then in the average risk division, an average project just carries the company because it's an average all the way down. And again, maybe they use the same. Maybe low is 10.8% then. And then maybe high becomes 12.8%. And so you could have overlaps. In fact, maybe even in your average risk division, this rate of return that you require for a high risk project could actually pass what you required low risk and the high risk. It doesn't really matter. You're just trying to get a feel for what's going on in each of those divisions and making sure that the risk and the reward match. So just because my company has an 11.8% weighted average cost of capital using the shareholders that we have now, that wouldn't be fair then for a low-risk project in the low-risk division to have to earn 11.8% because maybe there isn't that much risk there. So you would want to risk adjust it down to that project. Whereas maybe a high-risk project in the high-risk division, well, it actually needs more added to it because you're taking additional risk, so you need the additional reward, so you want to adjust that. And like I said, in Chapter 13, it's going to make more sense because you'll see how adjusting the risk and adjusting the required rate of return can make us accept or reject a project. So just hang in there with me. Just kind of understand why this is important for right now. Kind of adjust of the calculations. They're pretty basic. But just kind of get a feel for not only why we're doing the calculation, but how the calculation is done. Okay? So the why is we're trying to get to numbers that we can evaluate fixed assets with. The how it's done is more of what I'm going to be grading you on. So, questions or comments? Once again, the author doesn't have a whole lot of homework for this chapter, so instead of having one of those discussion boards that's assigned, I think I'm probably really going to just send you guys home with like a little take-home quiz or something that I can put some additional problems on. It's take-home, so you're still out to get all 10 points, but it's just going to be additional practice for you. So that's my goal, is to get you guys some more practice. Let me make sure I covered everything. Okay, that's everything. When I see you next time, I will hand back the exams. Remember, I can't do that because the online version is still open. I did post your grades, though, so you guys should be able